Hey everybody, it's John King with Summit Funding, and here I am with my weekly market update for all things mortgage related. So let's kick it off. I'm going to cover three topics today. First topic I'm going to cover is interest rates. Rates have gone crazy over the last few weeks, and I want to give more depth into what's going on and where I think they're going. The second thing I want to cover is I want to cover second homes. Second homes are becoming a much higher risk. Fannie Mae and Freddie Mac came out with a change in guidelines a couple of weeks ago. Guidelines change in perspective on how they look at second homes compared with primary or investment homes. And I'll explain more about what that means. And then the third thing I want to talk about is condominiums and why condo loans have just become significantly harder to obtain. All right, let's start at the beginning with interest rates. I've been talking all along about inflation. Inflation's been the significant concern over the last few months, really over the last 6 months or more. And the Fed, as I had mentioned recently, has finally decided, hey, this is something that's kind of serious and I need to do something about it. So the Fed had said, we're going to start raising interest rates, but to raise interest rates, they have to stop buying mortgage bonds. And they said they were going to do that around summer. Then over the last couple of weeks, they accelerated their timeline. They said, hey, this inflation thing, it's a lot scarier than what we thought it was. It's creating bigger impact to the economy. And the Fed's number one tool to stop inflation is to make money more expensive, to raise interest rates. And so that concern over interest rates and how quickly the Fed needs to start raising rates has made them want to raise rates faster, and it's made the mortgage market super scared because we're worried about how aggressive the Fed is going to get in raising interest rates. And to be super clear, the mortgage industry does not wait for the Federal Reserve to increase interest rates. And a lot of people confuse the issue. They say, hey, the Fed announced they're going to raise rates, so I need to get my mortgage before that happens. The Fed does not control interest rates. Interest rates are controlled by the private market, and the private market sees the writing on the wall. So rates are already moving up. The question is, when are they going to level off? We are squarely in the high threes. I think this year we're going to end up in the mid fours once we level off. The question is, are we going to stop temporarily here? I hope that's the case. I think we'll end up having another bump in interest rates later on this year as the Fed really accelerates what their process is for raising rates. But in the meantime, we're trying to figure out when is this current surge in interest rates going to slow down? When's it going to hit its happy medium on its way up? I'm thinking it's hopefully going to stop somewhere in the high threes, maybe the low fours. Only the next few weeks will tell. So let's keep our fingers crossed that we see rates start to level off a little bit. I really don't hold out any hope that rates are going down anytime soon. So just be clear, we are in an upward trajectory for interest rates for the foreseeable future. Second topic I want to talk about is second homes. So let me give you a brief primer. There's only three ways that the mortgage industry looks at occupancy: primary, second or vacation home, and investment property. So a primary home is the home that is the place you spend most of your time, the place where you are within commute distance of your job. An investment property is kind of the opposite end. It's the catch-all. So investment might be a rental property. It might be a property that you just bought for your sister to live in, but it's not your primary home and it's not your second home. So it falls into that third category of investment. Investment property is the highest risk category because the industry believes that if bad things happen, if you lose your job, if money becomes tight, you're going to pay for the roof over your head long before you're going to pay for the roof over somebody else's head. But up until now, the industry has treated second homes with the same level of risk, AKA interest rate, as how we treated primary residences. So if you bought a second home, the definition of a second home is a home for your own personal use, typically in a resort or vacation like destination, typically 50 miles or more away from your primary residence. If you buy a second home, up until now, the industry has treated the risk the same as a primary residence. Other than needing a little bit bigger down payments, you could get the same interest rates on a second home as what you got on a primary residence until now. Now the industry has taken the approach starting April 1st. Now that's for loans that Fannie Mae and Freddie Mac purchase on April 1st. Lenders have to decide when to start applying that to the interest rates when they lock them, because we've got the time from lock till close and then after close to get the loan sold. I think it's coming pretty soon that we're going to see a bump in the interest rates, because what they are doing is they are going to match the interest rate on investment properties is going to be the same as the interest rates on second homes. That's anywhere from 0.25% to a half, sometimes even 0.75% bump in interest rate compared to a primary residence. If you know somebody who has a second home right now that they want to refinance it, pull some cash out, or if they have the desire to purchase a second home, this is a good time for them to get into it because we're about to see a significant bump in second homes. Just so you know, kind of some of the guidelines around what is a second home, as I mentioned, it's for your own personal use, typically in a resort or vacation like destination. Think Lake Tahoe, think the beach, and it needs to be 50 miles away from home or more. But those are general guidelines. There are times when you might buy a second home that is in the location where your kids and grandkids live, and you travel there so often, you don't want to stay with them and you don't want to stay in a hotel. You buy a second home for your own personal use. But we can never count rental income on that second home because it's for your own personal use. All right, that's it for my second topic on second homes. Just be aware rates are going to be going up on those pretty soon because it's based on uh, loans being purchased by Fannie Mae or Freddie Mac after April 1st. The last topic, the third topic I want to talk about is condominiums. Condominiums just became much more difficult to finance through Fannie Mae and Freddie Mac. Here's why. I think it was last year, the year before, I think it was maybe in 2000, that there was the condominium project that collapsed in Florida. And it happened, there was a lot of news after the fact about the fact that the homeowners association had ignored maintenance issues and ignored problems with the project and kind of put it off and put it off and was finally trying to get some work done on the project when it collapsed. And tragically, I think 100 people lost their lives in the uh, in the in the collapse of the buildings. So Fannie Mae and Freddie Mac are concerned not only over the loss of life and of the building itself, but they're worried about the financial health of the homeowners association, because even if the property doesn't collapse, if there's some significant levies of special assessments or increases to homeowners association fees, then that's going to harm the ability of the homeowners to be able to make their monthly payment, to be able to pay for their mortgage. And it may drive down the value of the property and cause a greater number of foreclosures or short sales within that particular property because of the deferred maintenance issues. So they came out recently, effective January 1st, and said that lenders have an obligation now to dig significantly deeper into the homeowners association when it comes to looking for deferred maintenance issues. So if there's any special assessments, we've got to dig deep into those special assessments. If there's any indication on the appraisal about any deferred maintenance, we need to dig deeper. And if there truly are deferred maintenance issues, the property becomes what's called non-warrantable. So in other words, a property that meets Fannie Mae and Freddie Mac's guidelines, that's a warrantable condominium project. A non-warrantable project doesn't meet their guidelines. I have loan programs to help out with non-warrantable projects, but the interest rates are higher, the down payment requirements are higher, the fees are higher. We are much better off having a project that meets Fannie Mae and Freddie Mac's guidelines. So just be aware as you are thinking about buying a condominium, if you know anybody or you're an agent serving clients that are buying condominiums, lenders now have an obligation to dig significantly deeper, sometimes even to the fact of getting 6 months or more of association meeting minutes to dig into what the meeting minutes are talking about. Sometimes it means getting bids for the work to be done and reviewing those bids from the lender's side, reviewing those bids to see what the true nature of the deferred maintenance is. But from what I'm reading and from what I'm seeing, this is definitely a significantly larger burden that is temporarily placed on the lending industry to dig deeper into these projects. I hate temporary rules because they never seem to go away. So this is one of those, I don't know when it's going to end or when they're going to relax this guideline, but for now they've put the burden on lenders. If you have a client or you're buying a condominium, be aware it is going to be a much more cumbersome process. Cumbersome equals time and it may equal money. It's going to take longer to close escrow if we have to dig deeper. We might have to order more extensive reports from the homeowners association, which might cost the buyer more money. So just be aware as you're looking at buying a condo that it is going to become a little bit more challenging, a little bit more cumbersome and lengthy process, and potentially more expensive. Hope you got some great information out of today's episode. We'll call this an episode. Please feel free to call me or reach out if you have any questions about anything. And just remember, I'm here to serve you or anybody you know who's looking to take advantage of the market in purchasing or refinancing a home. I'd love the opportunity to take great care of you, and I hope you have an amazing day. Talk to you soon. Bye bye.